We're back with another episode of Living in Granbury and Beyond. Today we're looking at a couple of updates on the market and the interest rates. A lot's changed and just giving some projections so we can kind of make plans for the coming year. So if this is your first time to the channel, we really appreciate you tuning in to today's episode. Be sure to click that subscribe button and press the bell for notifications so you'll be the first to know about any changes or updates going on here in the area. So as always, we get people that are tracking things. Maybe they're planning to retire, maybe they're looking for a vacation home or a lakefront property. We really appreciate you tuning in and really appreciate you listening and would love to hear from you. Give us a call, shoot us a text, send us an email. We'd love to connect with you and answer any questions or give any advice that we can. So with that, we're actually going to jump into a couple of things that have come out here in the last few days. Obviously, the government shutdown appears to be nearing its end. I believe there's a vote happening. Today's November 12th as I'm doing the video. But it looks like they're going to be voting on it in the House tonight, November 12th. But it looks positively like it is going to be moving toward the shutdown being over. With that, there's going to be some optimism in the market. The stocks should rally around that. Hopefully the flights and stuff, because they were actually doing they were saying, well, 5% of the flights have to be canceled because of the aviation flight risks. Obviously you saw the UPS crash with the plane happened here recently. So there's a push for them to start diminishing that, which was going to hurt travel, which was probably going to hurt shopping, Black Friday, which was going to cause more depression in economic activity, which is not what you're looking for during this time, especially if you want the economy to be stimulated. However, a slowing economy with, moderate sales might lend itself to potentially more movement by the Fed on lowering rates, possibly lowering the 10-year Treasury some, which would have a positive impact on mortgage interest rates. With all that said, the major thing that I've been calling for the last couple of days and weeks is the labor market. What's going on with the labor market? Jobs. Are the indicators showing that the job market is strengthening, getting stronger, or is it weakening, getting weaker? And how fast is that happening? Whenever we hit a certain threshold with jobs, we're going to see the Fed have to make more aggressive moves to lower these rates, to stimulate the economy, to fix the job loss, recession, as it begins to happen more rapidly. As the labor market begins to deteriorate more rapidly, that becomes the major concern. And we're flirting with that line right now. We're flirting with it. Okay, so I want to start by sharing my screen. So we've got October layoffs hit 22-year high, legal considerations for employers. So there's several things that have happened here. I'm going to actually move this over so you can see. I've kind of compiled a few things here. UPS laid off 48,000, Amazon up to 30,000, Intel 24,000. We could go on here about these people that had layoffs. What was the cause of these layoffs? Well, it's a couple of things. One's the market. One of them is AI, artificial intelligence, that is causing them to get rid of some of these redundant positions. So there's a lot of things that AI can now handle. And as it gets better and better, more and more people are going to be laid off so that these data centers that they're building all over the place will be able to process this information and answer it. So think about like a receptionist. I actually looked at a company, I think it was called Rosie, and they are an AI company that answers the phone for companies like my real estate brokerage. They will answer the call and they will process and route this person to something so that they can get a call back or get an answer. Now, personally, I don't want to send any of my folks to AI. I'm not comfortable doing that. There's a potential that it actually could get really good, and it might make sense to do it in the future. For right now, when I'm busy, I have it routing to real people that answer the phone for me. But there's cost savings. I mean, it's a lot cheaper to route it to Rosie than it is to route it to real people. So those sorts of jobs are being passed on, and Amazon is laying off a bunch of people, and UPS and all these others. So with that, that's a part of it, the AI. Part of it is the deterioration where the market is just not able to sustain it. So a combination of those things, the government shutdown could have had something to do with this as well. So with that, these numbers are very concerning for the Fed, and the news of this is sending the 10-year Treasury yield down. That is having a positive impact on the mortgage interest rates. So So some of this data that's coming out is showing a trend down that's happening as a result of this report that came out showing jobs data going down. Okay, so that's what we see. So as we watch the labor data, this tells us that we should expect, if this continues to happen, we're probably going to see rates begin to move down a little bit more aggressively than we have so far. They did do a 0.25% cut last month and the month before that. So they've already started signaling that's the direction they're going to head. We don't know how long it'll be. Will they do another quarter, or will they hold it where it's at next month? Hard to say. The inflation is still kind of persisting more than they want, but these job numbers they're the most concerning bit right now, because once it starts to happen kind of rapidly, it's hard to get out in front of it, and it takes time, and it's not something that the Fed really enjoys, to say the least. So not only are October layoffs hitting all-time highs, but before we jump into the talk about this 50-year mortgage, I want to tell you why this is front and center for people, and it's this. There was reporting that came out. If you click here, housing crisis affordability is so bad that average Americans first-time homebuyers is 40 years old. 40 years old. That is a record. 40 years old is the average price. Repeat home buyers on average are 62 years old. So the people who are buying homes are averaging a much older age because they've got a lot more money and liquidity than the folks that are younger. That is not a good sign for the economy at all. This is a terrible metric. And because of that, there are attempts right now to explore mortgage options that might make housing more affordable so that we can get this age range back a little lower. Let's just look for fun. Average age of home buyers in 2017. So this right here says first time. This is not just home buyers. First time home buyers is 40 years old, and repeat is 62. So in 2017, this is crazy. The average for first time home buyers was 32, and the median for all buyers is 45. So it went from 45 to 62. And it went from 32 to 40. Think about that. That is like huge swings that's happening. So that news is what's caused the Trump administration and others to begin to explore other options to make housing more affordable. So they put forward an idea of a 50-year mortgage recently. It did not go over very well. So essentially you were looking at, almost doubling the amount of interest or tripling the amount of interest you pay. And it only decreased your mortgage by like $200 to $300 a month. $200 to $300 a month savings. It took you from 30 to 50 years. And the pace at which you accrue equity was drastically reduced. So it really just didn't seem like it was doing that much. It just, the marginal impact on the approval was small, but the impact on the payments on interest was large. So it doesn't seem like a great fit. There is some new talks coming out here recently about something called portable mortgages. So essentially the idea here is that you can take a mortgage that you have. Let's just say you've got a $500,000 home and you put $100,000 down and you've got $400,000 that you have loaned out. So you've got a mortgage for $400,000. You've been there for 4 years and you've paid it down to $380, just to make the math easy. Okay, so you got $380 here, and you want to go and buy a $600,000 home. Okay, so can you take this $360,000, transfer it over to that property, that $360 transferred over to that property, and then just get a loan for an additional $100, maybe, and use whatever you make on your home to move to that new property. So essentially you get to keep that 3% interest rate on that $380 that you currently have. You don't lose that. You keep that $380 loan from the bank at 3% interest. You keep that, and then you have to do some sort of second loan to finish the payment out, or just substantiate it with cash from the sale, whatever. You see what I'm saying, hopefully. Clear as mud. So basically you could keep your mortgage. Now there's all sorts of questions on that. So for me, I'm looking at it and thinking, oh my gosh, like that is a quagmire. Like the bank that has this, they've got a lien on that house. Can you imagine keeping the money while losing the house, and you go to another house, and like, how does the mortgage company protect their loan asset and keep themselves protected because they don't want to just give you $380,000 at 3% interest rate to go do what you want with it. So how are they going to connect it to the houses? And oh man, I just, whew, that is going to be a messy thing. I like the idea though. I do. I really do like the idea. If we could do that, I'd sell my house and go buy something now if I could keep my interest rate. I mean, I'm not moving partially because I've got a 3% interest rate on the house, and it's like my payments would double if I bought the same house, the same size house right now. In order to really make sense of this, I would want to keep the current interest rate in place and just eat some of that extra. That would be beautiful. I would love that. So they're working on things. Again, why are they doing that? Well, the economy is not doing that great. We've got layoffs and labor problems that are happening, and inflation has continued to persist more than anyone really wants to acknowledge. And the average first-time home buyer has moved from 32 to 40, and the average age of buyers has moved all the way up to 62, which is just crazy to think about. It was 45 in 2017, so that's a big 17-year jump on the average age of a repeat buyer. So those things are causing administrations and people to begin to think about, how can we make this more affordable? Well, I've got an idea. I've got a really good idea. Let's get rid of property taxes. Get rid of property taxes, and we can drop mortgages by $500-$600 a month. That's more than this 50-year mortgage stuff, and these people get to keep these properties. You might say, well, that's going to open up a quagmire. Not to say that it wouldn't, but there's got to be a better system, because all these people, me personally, my kids don't go to the Granbury ISD, and yet I'm paying all those taxes. So I do wish, not just for my sake, but for the ability of people to purchase homes, I wish there was a way that we could get these property taxes down, because they've doubled almost since I've purchased my home. And that I think is a killer for affordability. I had some folks that were coming in looking at homes, and it was like a $400,000 home. They were going to put $350,000 down. $350,000 that means there's going to be a $50,000 mortgage. $50,000. And the payments came back at like $1,500 a month for a $50,000 mortgage. And I like to fell out of my chair, and it's like, oh yeah, well, property taxes are like $800. And this was not in Hood County. It was in Tarrant County, where property taxes are even more ridiculous. One thing I can say about Hood County is that they are lower than all the other counties around. So that is definitely in its favor. So I think that sheer, just a shock of how much we're spending per month on property taxes is really contributing to this affordability crisis that's happening and causing people to become older before they can purchase. It's not just the interest rates. It's the dang property taxes, man. That's a killer. And then you've got, on top of that, you got the homeowners insurance, which has tripled for me since I bought my home. It's tripled, threefold. It has gone up 300% since I've purchased my home. So if we could focus in on property taxes and homeowners insurance, create some ways in which we can maybe have roof exclusions or have higher deductibles and actually do a real reduction in homeowners insurance, I think that would help with affordability a lot more than making a 50-year mortgage. Now, the portable mortgage, I think that will stimulate the heck out of the economy, because a lot of these people that are locked in will actually be able to go and buy, and I believe that will help out tremendously. So with all of that, I hope that you found this information helpful. What's going to happen in the market, we're keeping an eye on it. With the shutdown hopefully coming out soon, there's going to be some more reporting with jobs and interest rates and inflation data that should be coming out, hopefully in the next couple of weeks. I might do another one. I'll probably do one more market update before the new year starts, maybe before Christmas. But until then, I think this will be the last update until we do that kind of year-ending one, and we kind of give some projections. If anyone has any questions or has any insights, I love to talk to listeners about stuff, especially if they have interest in this. Or if you're just thinking, I'm thinking about retiring, we're going to be retiring and moving and buying, and what should we do? How should we do it? I love to answer those questions. Love to visit with you if you had some time. If I don't hear from you, hopefully I'll see you around Granbury sometime.